Been a bear on gold since it was north of 5,000 for a downside move to basically sub 4,000 we've now achieved. I still think based on the chart that there might be one final flush down to about the 3,500 level. Wedge patterns, they start to contract, squeezing price between, which starts to build the explosive ability for gold. Now, this is where you can be a shorter term bear, but really longer term mega bull on gold. The government spending, the lack of fiscal control, all of these things play into much further upside. You did have a certain amount of money exiting Bitcoin and rotating into gold.
How much of this recent volatility you think had to do with the recent reignition of the war on Iran, the ceasefire being over, renewed attacks from the US, and oil going back from high 60s, low 70s to now $81 a barrel?
The biggest risk for oil is that the price up on oil causes inflation, which eventually causes a recession. And that is the killer. That's the one. When we start to hear that word recession and we see growth slow, when we see jobless claims start to spike.
Gareth, let's take a look at gold now. Because of the threat of higher interest rates this year, several institutions have been lowering their forecasts on gold. The Bank of America has downgraded its 2026 average gold price forecast by 14% to $4,360 an ounce. Right now, we're at $4,000. Gold's been trading around $4,000 for quite a few days now, and it's been having difficulty breaking below and maintaining above 4,000. And anyway, I'll get your take on gold and why it's been having trouble moving around $4,000, and ultimately whether or not you agree with some large banks' forecasts that we should be downgrading our outlook for gold given the potential for higher interest rates this year.
Yeah, so I think that, in general, I agree that the crazy forecasts for year end are ludicrous, right? I mean, I've been a bear on gold since it was north of 5,000 for a downside move to basically sub 4,000, which we've now achieved. I still think based on the chart that there might be one final flush down to about the 3,500 level, but basically anything below 4,000, I'm starting to look at it very attractively as a buy. And part of that goes along with the thesis of if I'm not a believer that there's going to be any rate hikes, or if at all, maybe one, then I think then that is starting to make the bull case for gold to start to push up. Now, on a technical basis, when we look at the chart, we have this beautiful wedge pattern, right? So you can see, amazing.
Wall Street keeps lowering gold forecasts even as the structural risks driving long-term demand remain firmly in place. Gareth Soloway notes the current weakness may simply be the final stage before a much larger opportunity emerges for patient investors. Forecast cuts often arrive after prices have already corrected, leaving retail reacting while institutions quietly prepare. For savers, the bigger danger is confusing short-term volatility with long-term value. Next, Gareth Soloway exposes why rate hike fears and institutional positioning are sending completely different signals.
How this high starts the formation of the low, 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 and low. And sure enough, where are we? We're right at that same support level, which is holding. It is holding as of now. One of the things to keep in mind is wedge patterns, they start to contract, squeezing price between, which starts to build the explosive ability for gold. Now, the explosive question mark here is which way does it go, right? Does it break to the downside or does it explode out to the upside? Right now, based on a few different metrics, it's telling me there's more of a chance of one final flush out down to this level around 3,500 right here. Notice this is the peak from all of these high pivots right along here. And so if we get one flush out there, I think that's where we bottom out. And then looking towards later this decade, over the next couple of years, I think gold is headed much higher. And so, this is where you can be a shorter term bear, but really longer term mega bull on gold. The government spending, the lack of fiscal control, all of these things play into much further upside over the next few years, even though it's washing out a lot of the weak hands in this drawdown.
What happened to the markets earlier last year and late last year and earlier this year? Gold peaked around the beginning of the year. Bitcoin peaked around the beginning of last year. Several tech stocks I mentioned are down. That's not to say there's been a lot of momentum and squeezing in other areas in the markets, like semiconductors we talked about earlier in the year. But
major market bottoms rarely arrive when investors feel comfortable. They form while uncertainty reaches its highest point. According to Gareth Soloway, gold's contracting wedge reflects mounting pressure that eventually forces a decisive move in one direction. History shows these technical compressions often coincide with emotional capitulation, where weak hands exit just before longer-term trends reverse. Investors chasing headlines instead of positioning risk, missing the most attractive entries. Next, Gareth Soloway reveals why fiscal deterioration ultimately outweighs today's short-term technical weakness.
It looks like a lot of the asset classes that had a huge run into 2024, into 2025, slowed down late last year and into this year. Was there a pivotal change that happened in the beginning of the year that we should address? I mean, besides the war in Iran, which obviously changed the calculus for rates. But other than that, what else happened?
So I think a couple things. So number one, the run on gold, where we had this next phase of the bull run from October all the way into January, that coincided with Bitcoin topping. So if we remember, and we can quickly look at the Bitcoin chart here, I'm sure we'll go into it in more depth in a little while, but Bitcoin topped back in October, right? And so you did have a certain amount of money exiting Bitcoin and rotating into gold. And I think that's part of the reason. And you can very clearly see this drop on gold, on Bitcoin, all the way into basically the end of January, early February, coincided perfectly with the incredible rally in people chasing gold that topped out in late January, early February, right? From that point on, Bitcoin has gone down further, but it hasn't gone down with the same velocity, and so has gold. And I think a lot of that is because money was rotating out into the semiconductor trade. I mean, think about it from this perspective, is that people that rushed into gold in this run from basically 4,000 to 5,600, they were get rich quick investors. They weren't investors that had been in gold for 10 years and were just buying a little bit more. They were get rich quick, right? Bitcoin players in general, if you're in crypto, you're expecting, oh, I have an altcoin, where's my 100x?
The biggest market moves often begin with capital quietly rotating long before headlines acknowledge the shift. What Gareth Soloway is highlighting is that money didn't disappear. It simply chased whichever asset promised faster returns at the time. That challenges the popular narrative that gold suddenly became fundamentally weaker. For long-term investors, following institutional capital flows matters far more than reacting to emotional price swings. Next, Gareth Soloway unravels why speculative money may reverse course faster than most expect.
Well, guess what? You could make 5x or 10x in semiconductors from October last year into mid this year, right? We saw those incredible runs. And so I think it was a combination here. And the question I would say is, if the semiconductor trade tops, and we've already seen it start to top, does some of this money come back to Bitcoin? And does some of it come back to gold? And I think there's a real case to be made later this year that I do think, as the stock market comes down, which has been the hot play, I think some of this money does rotate back into Bitcoin and gold. And so even if we don't get that flush down to 3,500, I think gold, again, has a lot of positivity into year end.
Okay. Well, let's talk about Bitcoin then. Right now, 63,000. And similar to gold, it's been trading range bound here. Is this a bottoming pattern for you, Gareth?
It is. It is, at least in the near term. And listen, a bottoming pattern can fail if you ever take out this low here, which is the head of an inverse head and shoulders. It's a bullish pattern in technical analysis. Then it would negate the pattern. But until then, shoulder, head, shoulder. I like the fact that if we look at Bitcoin, how has Bitcoin performed versus gold, silver, and the stock market over the last week or two? It's actually outperformed. So I'm taking those as breadcrumbs telling me, okay, there's something going on here. There's rotation of capital back into Bitcoin in the near term. And maybe we're due for a run up to about the 71, 72,000 level. And that's actually what the target would be, the calculated target of this inverse head and shoulders. So
institutional rotations usually become obvious only after retail investors have already missed the first leg higher. Gareth Soloway's argument suggests leadership is quietly shifting as momentum fades in overcrowded sectors like semiconductors. Markets rarely reward yesterday's winning trade forever, despite what financial television encourages investors to believe. Protecting wealth means recognizing where capital is migrating before performance tables catch up. Next, Gareth Soloway reveals the technical signal separating a temporary bounce from a genuine trend reversal.
I am bullish on Bitcoin here, at least in the near term. If it ever takes out the 58,000 level to the downside, then I would have to flip back to being bearish for a move down to 50,000. But right now, this is a very bullish pattern on Bitcoin.
Okay, let's end on key levels for the asset classes that we're talking about. So S&P 500, what are we looking at here for the next key levels, Gareth?
So the big level, we talked about it just a little while ago, this one right here at 7,300, guys. As long as the S&P stays above 7,300, I would maintain a bullish bias on the S&P, maybe a little bit more neutral to negative on the NASDAQ because of the tech side of things and the unwind there. But that is your line in the sand. If we break below that, you should head straight to 7,000 because that, again, would be your high pivot from last year. And again, if that breaks, we could be looking at as big of a move down as 6,300 and maybe below. But let's start with that 7,300 being the key level. Which one do you want to do next?
Yeah, NASDAQ as well.
NASDAQ composite. Let's take a look. So the NASDAQ composite, short term, we very clearly see you have a low pivot right through here at around 25,000. By the way, that's incredible that it's literally at the even number of 25,000. So it's come down to 25 and they've held it above. Come down again, they've held it above. If 25,000 gives way, it's going to act like a dam breaking and you'll see price very quickly decline.
Bull markets rarely announce when risk begins quietly increasing beneath the surface. This is where Gareth Soloway's thesis shifts from chasing upside to identifying the exact levels where discipline becomes more important than optimism. Critical support levels matter because institutional selling accelerates once they fail, leaving emotional investors trapped. Preserving capital is often more profitable than forcing exposure during uncertain transitions. Next, Gareth Soloway exposes why one overlooked index level could determine the market's next major direction.
All the way to 24,000. So about 1,000-point drop there on the NASDAQ. So watch 25,000. Stays above, there's still hope for further bull market action. If it breaks 25, should be a very quick flush to 24,000.
We've already talked about oil. Let's skip that. My questions for gold and Bitcoin. Similarly, what would happen if the floor that they're forming right now is broken? So for gold, that's 4,000, and for Bitcoin, that's 60,000.
Yep. So if you take out this 3,900 to 4,000 level on a breakdown below this wedge trend line, you're going to head all the way down to this support at 3,500. 3,500 for me would be where I start loading up on long-term holds. I already have some long-term holds that I've held for years and years. This would be my buy and bull opportunity. So watch the 4,000, 3,900 level. If it breaks, goes to 3,500. On the other side, the wedge pattern can break to the upside. If we take out 4,150 or so, you could be headed back towards 5,000 in very quick order. So the wedge pattern, remember, it's like a pressure cooker. It's squeezing price. If it breaks one way or the other, you're going to get a big move in that direction.
Well, what are we waiting for right now, though, Gareth? What is a turning point in the market for you for this year, for the remainder of 2026?
Wow. So if we go back to the S&P 500, one of the things I'm watching is this, right? So the S&P honestly has held up much, much better than the NASDAQ.
Markets often spend weeks compressing before releasing months of volatility in a matter of days. Gareth Soloway notes that gold's tightening range leaves little room before momentum decisively picks a direction. The real opportunity isn't predicting every move, but preparing for both outcomes, while others remain emotionally committed to one narrative. Investors who plan ahead usually outperform those reacting after the breakout begins. Next, Gareth Soloway reveals why one breakout level could completely rewrite gold's outlook.
Recently, and the reason of that is simply that the S&P has 500 stocks, so it's much more diversified than the NASDAQ 100, for instance, which is very concentrated in the semiconductor trade. But one thing I will say is there's this parallel that we even talked about literally months ago when we did multiple interviews ago. We were watching this parallel, and we came up to the high end of it. It's parallel to these lows going back to the COVID low, and we broke above it. We broke out. The S&P broke out. There's no doubt about it. I remember talking about it with you. Notice how we broke out and we came back in and we held this line. We then bounced up. We came back in, we held it again, and we're up here. As long as we remain above this trend line, you got to give the S&P the benefit of the doubt. As much as I think the markets will slow later this year, from a technical perspective, the markets are still above this trend line, which is around 73.30 or so. As long as that stays there, technically the market is strong, at least on the S&P 500. If it breaks below that, that's where things start to fall apart and markets likely come down much, much harder and faster. So again, that is the line in the sand for me. As long as we stay above, I think the S&P can hang in there. If we break here, which I unfortunately think eventually we will, that's where you want to get really conservative and move over to a lot of cash.
How much of this recent volatility you think had to do with the recent reignition of the war on Iran, the ceasefire being over, renewed attacks from the U.S., and oil going back from high 60s, low 70s to now $81 a barrel in a pretty short amount of time?
The strongest markets often appear healthiest immediately, before confidence begins quietly cracking underneath. According to Gareth Soloway, the S&P remains technically constructive despite growing weakness beneath major indexes. That's exactly where headline optimism can become misleading, because market breadth frequently deteriorates before prices finally reflect reality. Investors protecting wealth should monitor structure instead of trusting reassuring narratives. Next, Gareth Soloway exposes the overlooked technical trigger that could rapidly change institutional positioning.
So I think a little bit of it, I think for the most part, as we saw even when oil was up in the $100+ range, the S&P and the NASDAQ were basically near or at all-time highs. And the old thought process is, well, the semis, right? The old adage, another adage is that where the semis go, the markets follow. And I think that's very true right now, is that, yes, oil has come way down, which is helpful for inflation and the Fed maybe not having to hike, but now we're seeing oil go back up. And now maybe the Fed might be forced to hike anyways. But you still look at the markets, and the markets today are down. Why? Is it because oil's up? Or is it because the semiconductors got hammered early in the day and now semis are bouncing, the market's bouncing? And so I would say that I think there's a point here where the biggest risk for oil is that the price up on oil causes inflation, which eventually causes a recession. And that is the killer. That's the one. When we start to hear that word recession and we see growth slow, when we see jobless claims start to spike, when we see the jobs data start to get, in terms of losing jobs, worse, that's where the price of oil is going to be scrutinized and mean much more. At this point, I don't think that a lot of this volatility recently is because of oil, just like we didn't see it back when it was north of 100, having a massive impact on the volatility in the markets.
Rising oil prices alone rarely explain broad market volatility, despite dominating financial headlines. What Gareth Soloway is highlighting is that semiconductor leadership may currently carry more influence than energy itself. That disconnect exposes how media narratives often simplify complex capital flows into easy explanations that miss the real drivers. Investors focusing only on oil risk, overlooking where institutional money is actually moving. Next, Gareth Soloway reveals the economic trigger that could suddenly make oil far more dangerous.
Would it change your view on the Fed policy, which we talked about earlier, their willingness to hike rates more than once if we see oil continuing to go higher?
Yes, I do think so. So there's no doubt about it, is that if oil pushes back north of 100 and stays there, that's going to have a longer term impact on inflation, and the Fed probably would have to act in that regard. I don't anticipate it. I've already, so one of the things here is there's a gap fill right here on the chart at around 67. That's exactly where price went. And then we've gotten this move. I plan to short oil if it gets up to about 87 right here. I still am in the camp that the president is very hyper aware, as we saw by his speech last night, that the midterms are coming up quickly, and he is going to do whatever he has to do to get that oil price down. So if we get to 87, I'm going to short it. I think we come right back in. I do not anticipate oil going back above 100 this year. I would be very, very surprised. And you can hold me to that in our next interview, that if oil goes above, I'd be wrong. But I think it stops at 87-ish or so. And I think by the midterms, we're back to the 60s.
Is that dependent on the situation in Iran, or is that just looking at the technicals, you think it's very difficult to break above 90 here?
Yeah, very, very difficult. So it's a combination, right? So again, it's understanding the box that the president's in because he has to care about the midterms and trying to keep the power in the Senate and the House. So he's not going to escalate to troops on the ground.
Political incentives often influence markets more than the economic explanations dominating television coverage. Gareth Soloway's arguments suggest policymakers have strong reasons to prevent sustained oil spikes before critical elections. That possibility challenges assumptions that energy prices are driven purely by supply and demand. Investors should watch policy responses as carefully as technical charts, because both shape future inflation expectations. Next, Gareth Soloway unravels why politics and technical resistance may be reinforcing the same outcome.
Or if it is, it's going to be very quick, very in and out types of situation. And also, if we look at the technicals on the chart here, look at how oil kept hammering on this zone right here on a technical analysis basis. When you hammer this much and then break, it is very hard. Like you can go back to that level, but then price, I would say about 80% of the time, 75% of the time gets rejected off of that level. So the combination of the two give me a very high probability that oil probably stays below 87, 88, maybe touches it, and that's where I would short.
What happens when we have the Fed raising rates? Let's talk about that for a minute. 2022 was a year that I think we all remember as bad for all asset classes that we track, pretty much all of them, the bigger ones at least. And people are talking about the very strong possibility of raising rates. The Fed's talking about that. And I'll ask you to comment on the degree to which they'll raise rates, because 2022 saw many rate hikes. This might not be the same. And if it's only one or two and 25 to 50 basis points, maybe we won't see that kind of sell-off if we saw in 2022. What do you think?
So the data that I'm looking at and just knowing how the Federal Reserve operates is they're talking a tough game here. I would at most expect one rate hike the end of this or later in this year, and possibly no rate hikes and even cuts as early as next year. And so I get that, you have Kevin Warsh coming out and talking real tough. He obviously has the Fed board that votes on rate hikes, and they're still talking tough. But in my humble opinion, is he is going to fight rate hikes very harshly because of the Trump appointment. He has to kind of answer to the president, as weird as that sounds. I know he's supposed to be independent, but at the same time, Trump was very clear that he was not going to be appointing anyone who was going to raise rates, right? And he always, think about what the president says. Anytime we see the stock market selling on good economic news, he has an issue with that. He takes an issue with that because he says, well, this is good. It should make the markets go up. And so it's very unlikely that we will get rate hikes, maybe one this year. But with my analysis showing that we're likely going to see an economic weakness towards the end of the year, it could pivot very quickly towards cuts in 2027.
Markets often fear aggressive rate hikes long after economic conditions have already started weakening beneath the surface. This is where Gareth Soloway's thesis shifts toward questioning whether the Federal Reserve can realistically maintain its tough rhetoric. History shows policymakers frequently pivot faster than their public messaging suggests once growth deteriorates. Investors relying solely on official statements may underestimate how quickly policy expectations can reverse.